In this video, we're going to look at how to account for trading in used assets for new ones. So here it says, assume that Rancho Landscape exchanges an old truck for a new truck costing $25,000. They received $3,500 trade-in allowance on the old truck, which had a book value of $2,000. Rancho pays the remaining $21,500 cost of the new truck in cash. The cost of the old truck is $10,000, and its accumulated depreciation here is $8,000. So what would that look like? How would we account for that? Well, here, our vehicles account would have to go up by $25,000 in relation to the new truck. But then we also have to remove the old truck. So the vehicles account would also have to be decreased in the amount of $10,000 in relation to the old truck that we're now trading in for the new one. But the old truck would be removed, but also its accumulated depreciation would also have to be removed. So the accumulated depreciation on the old truck we know is $8,000. So that would be removed as well. Now, we have, in this case so far, we have 3 accounts that would be updated. Now, we're also spending cash on this purchase, so cash is also going down in the amount of $21,500. Now, we need to see if there's any gain or loss here. So the book value of the old truck is $2,000. That's the remaining book value. But the amount of trade-in that they allowed is $3,500. So they valued the truck at $35,000, although its remaining book value was only $2,000. So we actually received $1,500 more for this truck than its remaining book value. So that represents a $1,500 gain on disposal. So we have this gain on disposal account that would have to go up by $1,500 here. So to journalize this, we are first going to debit the vehicles account for $25,000 for this new truck we bought. But we're also going to have to debit accumulated depreciation for the old truck, since when you remove an asset, you not only remove the asset, but also the cost of the asset, but also its accumulated depreciation. And the accumulated depreciation was $8,000 when they got rid of the truck. So we're going to debit accumulated depreciation or remove that accumulated depreciation off the books. Now we also have to remove the old truck. So we're also going to credit the vehicles account for the amount of the cost of the old truck. So we're going to credit vehicles for $10,000 to remove the cost of the old truck. And we're going to credit cash for $21,500 since we're spending $21,500 cash on this purchase of the new truck. And then lastly, we have to record that gain on disposal of plant assets. So we're going to just put gain on disposal here. So we're going to credit that gain just like we would credit revenue for $1,500. So we have our total here on the left, $5,000 plus $8,000, $23,000 on the debit side. Let's check that that adds up on the credit side. We have $10,000 plus $21,500 plus $1,500. That's $33,000. So this is what the entry would look like to record not only the disposal of an asset, but also purchasing of a new asset, and when that old asset is being used as a trade-in on the new asset. Here we happen to get more trade-in value than its remaining book value, so there was a gain on disposal, but if we had received less trade-in than its remaining book value, there would have been a loss on disposal recognized here.